Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Today we welcome Casey Taylor from Tailored Property Wealth back on the show. And he wanted to have a chat to us about what's happening in the mainstream media and how he believes that that's causing a little bit of analysis paralysis for people. We talk about the importance of creating a plan and making sure you're decisive in choosing those actions and those decisions to get to where you want to be. We also cast the spotlight onto the Brisbane property market. I ask him the question of whether it's approaching its peak, whether he sees some long-term value, and he shares some interesting stats on Brisbane and also some of the price points where he believes that we are getting some quality investment grade assets. It's a great broad chat about property investing in general, what he thinks you need to know in 2024-25 with a particular focus on Brisbane. I'm sure you're going to get something out of this one. Here's Casey. Joining me back on Geared for Growth.
Thanks, Mike Mortlock. Thanks for having me back on.
It's a pleasure to have you back on, and let's set the scene. We have you back on at the time of recording in the sort of the back end of July 2024, which is really well past the time where we expected to get interest rate cuts, and the media is obviously talking about that. We've got a big federal election coming up next year. There's a lot of noise about the cost of living, and there's a lot of noise about the property market, certainly Perth, Adelaide, Brisbane, all humming along. Will it continue? What's going to happen? Is it going to be, are we at the top of the market, or is there a boom coming when interest rates drop? There's so much to absorb if you're reading the newspaper. How do property investors navigate the time that we're in at the moment, do you think?
I think looking back at a lot of the noise that has continued on for decades gives you a good indication of some of those, I guess, recurring themes, and just not to let that kind of affect your decision making and taking that action. Because the reality is, if you look at past data on, I guess, the property market, the reality is that prices continue to increase over time. Sitting on the fence, just waiting to kind of take that action, it's really just going to cost you. You're going to have to go out there, pay more for the same asset you could have purchased 12, 18, 24 months ago, and you're having to borrow more for that same asset.
How often, when you're having initial inquiries with people as a buyer's agent, does the concept of waiting for X pop up, waiting for interest rates, waiting for the market to calm down, waiting for some world event to happen? How often does waiting come into the narrative of people?
I think at the moment, and probably for the last couple of years, that's definitely something that's been on people's mind a lot, right? Because we've gone through this interest rate rising cycle and people are concerned about that cash flow. It could be like a 50-50 split potentially with people that I'm speaking to, but what I kind of find that kind of stands out is there's people out there that find the excuse to go out there and take action, look at those positives why they should take action. And then there's others out there that are kind of looking for those excuses why not to take action potentially. And I think that's just a reflection of where their mindset is at. And sometimes that's a matter of coaching and educating people through that. But then there's still some people that just, you can give them that little push, but sometimes they still just don't take action because they think we'll wait for those rates to drop and then we'll go out there and purchase. But the reality is you're probably going to be competing with more people, as we've seen investor activity increase over the last 12 months. That's continuing on once people adjust to, okay, it's not the end of the world with interest rates a little bit higher to where they were, and they continue taking action. But there's going to be more people that jump back into the market, I think, once that does take place. No one's got a crystal ball. It keeps getting pushed back. But it will happen in the future, right? At some point.
That's an interesting point. I guess, like maybe there are some examples where, okay, if I wait for X to happen, I will have a better understanding of my risk profile, or I will be able to avoid, let's say, this thing happening because there was a political party that said they wanted to do that. They lost the election, so now I don't have to worry about it. But I guess you've got to think, am I the only one thinking like that? And chances are, in the world of property investing, you're one of maybe 1 million people that are thinking along similar lines. Is that fair to say, you think?
I think it would be fair to say. There's a lot of people in Australia, and Yeah. I think it's important to kind of separate yourself from the pack, right? And keep taking that action. That's what it comes back to. And there's so many ways to, I guess, set yourself up in a way where you are mitigating your risk. And there's a lot of people out there that have large savings buffers, or they're in a position where they've got really strong, healthy equity. And you can position your finances in a way where you can set up buffers in place so that if rates do continue to go up and we see another rise or whatever that looks like, you've got yourself in a position where you mitigated, you have those buffers in place, and you can be in quite a safe position as such.
So for the people that are waiting, but it's clearly just a psychological barrier that's in the way of them pulling the trigger or making a decision. I mean, how much of a psychologist do you have to become, and what is it that you think is holding people back? Because I mean, there's the old adages that the best time to invest was yesterday and buy land because they're not making any more of it. You know,
20 years ago.
How do you break that?
I think it's really just highlighting what do you want your future to look like, and do you want to improve your future? And that really comes back to taking that action, right? That's how I guess you need to look at it. What is the decision you're making today going to look like for your future in 10, 15, 20 years' time? And you don't have to go out there and build a massive portfolio, right? It might be a matter of just getting those one or those two properties. And we know that, what is it? It's roughly around 71% of investors hold one property, and that are those mum and dad investors. It's not, everyone likes to demonize landlords, right, and think that they're this super, super wealthy person. But the reality is that majority of people are mum and dad investors. They hold one or two properties, and that's just their little nest egg into retirement when that does take place in the future.
So to extrapolate from that, could it be more of a planning problem? So people might think intellectually, well, I know investing in a property is going to be beneficial for me financially, but they haven't necessarily mapped out or modeled, okay, well, if I buy this property now and it grows at this amount and I can buy another one in 3 or 4 years, I get to X point where my income is $100,000 a year or $200,000 a year. Do you think they're missing that kind of next level planning analysis that maybe would make them go, all right, well, I've mapped it out. This is what I want to achieve. This is how I have to do it to get on that path. Do you think maybe that's the gap? It's the planning. There's a bit wanting there.
It's a planning piece, and again, it just comes back to, I guess, that education piece as well. You understand that over time, that property that you purchase naturally is going to increase in terms of the rental income, which then naturally increases your gross yield or your net yield on that original purchase price. And it might be costing you, let's call it $200 or $300 to hold that property now, but in 2 or 3 years' time, that might start to get to a position where it's neutrally geared because you've had that rental income growth, but we might have seen potentially, let's call it, a couple of interest rate decreases, which helps naturally increase that. So I definitely think it's a education piece and a planning piece, and just understanding what that looks like over time. Just because it's going to cost you $200-$300 to hold a property potentially right now doesn't mean in the future it's going to look like that.
Well, there's plenty of episodes in and around planning on this show, so encourage people to look those up. But let's talk about, once you've got that done and you are going to pull the trigger, I mean, you've got the whole of Australia to invest in. I mean, you can go broader than that, but we tend not to talk about that on this show. The markets that are available to you are, of course, are diverse. There's capital cities, there's regions, there's states with all different fundamentals. There's capitals and areas in and around capitals that are at different points of the market. And one area that you flagged you wanted to cast a bit of a spotlight on is Brisbane. Now, I think anyone that has been sort of in that analysis paralysis and absorbing the mainstream media at the same time will realise that Brisbane has had one hell of a run. It's a market that was talked about for probably 10 years. It was due to run and it did absolutely nothing. And people would say, well, it can't be so much cheaper than Sydney for so long. It must come up to an equilibrium, and that didn't prove necessarily to be true. But now it's had a hell of a run, and people are perhaps asking the question, well, from an affordability comparison point of view, is it approaching the peak? I'm interested to hear your views on that.
Yeah. And look, we like Brisbane, and it definitely has gone on quite a large run. But it's coming back to those individual areas and local government areas in a particular city, right?
Yep.
And just because it's Brisbane doesn't mean that 2 kilometres from the CBD is the same as 20 kilometres from the CBD, right? There's lots of different areas within a city that we can focus on. And there's just a lot of exciting things in the Brisbane marketplace where we see that area, we believe it's going to continue to perform strongly. And just consistently long term, right? And what we do within our business and what I do as a property investor is I'm looking at what that property is going to do over a 20 or 30 year period, not necessarily just for the next couple of years. So it's really having that long term mindset when we're going out there and investing in property. And that's why we also like those metro locations for a number of different reasons, right? There's a massive amount of demand still in areas that we're targeting in Brisbane. Some of the properties that we get through at the moment are still getting 30, 40 groups through them. And that comes back to an affordability piece in those areas. And the median days on market for some of these suburbs are still under 15 days on market. So they're still selling extremely quickly. And that's because there is that affordability piece. Price point is lower to naturally, I guess, the median value of Brisbane as a whole. So it's understanding those individual markets where that affordability piece is, and people still have the borrowing capacity to be able to go out there and push those prices higher in those particular areas.
When you are looking at transacting on a property that's in demand, 30 or 40 groups is a hot property. There's obviously risks that it's maybe a very, very inflated market and the tide could go out to some degree. What gives you the confidence to transact, given that, okay, well, maybe we are approaching the peak somewhere, somehow, and there might be a period of consolidation or a slight drop, but what gives you the confidence over a long time frame that these markets will stand up? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well. Just to scrutiny over, say, a 10-year period.
Yeah. I think one of the big things that we like in Brisbane at the moment is the Olympics, and that's kind of just instilling a lot of demand in that market over a long period of time. There's a massive amount of infrastructure going on in Brisbane at the moment. The Queensland government just here noting it's committed to $16.4 billion in major capital projects. This is 2023-24. So there's just a massive amount of jobs that are going to come from that, population growth moving to the area. So it's just going to keep pushing that demand long term, which is, I think, very exciting. The ABS also believes in the next 20 years that Brisbane will have a population of roughly around 5 million people, and 75% of the job growth and population growth and income growth is expected in Sydney, Melbourne, and Brisbane. So there's just a lot of data from that point of view that's quite exciting, I think, as both someone who invests for clients in Brisbane, but as a property investor myself in the Brisbane area.
And when it comes to the price point, I mean, you talked about affordability, and I think if we look at 2023, 24, it was a year of affordability because the affordable markets really soared. Brisbane, one of them, Adelaide, one of them, and Perth, before it started its run, was the second cheapest median property capital city after Darwin, right? But we are getting to the point where, okay, well, now I should say Perth is kind of mid-pack. Brisbane has had a lot of a run. What sort of a price point are you able to transact at the moment on properties that you would consider investment grade? How let me cut to the chase. How much have we got to spend, Casey?
Yeah, and that's the main thing, right? How much do we need to spend? How much can we borrow to get something? Look, it does vary a little bit across, like I said, the different local government areas. I think a really good price point now is like that 600 to 650. That's still going to get you a 4-bed, 2-bath property, nice large 600 metre square block. But if the price point is a little bit lower, we can pivot and find like that 3-bed, 1-bath property. But prices 12 months ago, we were still securing things under 500K, whereas now that same property is well into the 600. So it is growing quite rapidly. And even just this year, at the start of the year, prices in Brisbane just started to really pump again.
And so at that 600K mark, we're talking about, 4-bed, 2-bath, something like that. Are we talking in the sort of 10 to 20 kilometre ring from the CBD, or is it 20 to 30?
About the 20 to 30 mark.
Yep.
So, and it obviously varies within that. Some's a little bit closer to the 20 mark and some is a little bit further out. So it is further from the city, but it's really understanding those individual local government areas and the local income, the industry sector of employment in those areas as well, where people still want to live.
Yep.
And what we are also finding on the ground last weekend when I was there speaking with agents is there's a little bit of a demographic shift in some of those areas. Some people are kind of starting to retire, sell their property, and a lot of the first home buyers are moving into those areas because of that affordability piece. So it's kind of changing that demographic, and progressively over time, they're going to create families and all the rest of it. And that gentrification piece kind of takes place as well.
Well, I'm glad you mentioned that, because I was going to ask about, this distance from CBD and the 10K to 20K ring. Do you think that's kind of overinstated? Because these are communities that it's not like the only shop is in Brisbane CBD. Like, these areas have their own amenities. They have little strips. They have pockets where people can get their artisan breads or their almond lattes or whatever hipsters buy these days. I don't really know. But do you think it's kind of over-egged? And perhaps more important is, well, what's actually going on there, and what does scarcity look like there? Because I think in the back of people's mind, they're thinking, okay, if you go 30 or 40K from the city, there's a chance that there's paddocks that can be turned into housing developments, so you lose that scarcity aspect. Do you think it's over-egged, that distance to CBD measure?
I think so. And I think Jeremy Shepherd has some data around really breaking down that distance from the CBD, and that kind of is a little bit of a myth. It really just comes back, like I said, to that local government area, that local suburb that we're looking at, and looking at a lot of different indicators as well from that. So building approvals, is there a massive injection of supply in those areas? Or despite it being further from the CBD, is there still that scarcity of land and scarcity of quality assets in those areas? Yep. So I think that despite it being further from the city, there's still that demand. And like you said, there's lots of amenities still in those areas, and sometimes there can be second CBDs, for example, a little bit further from the city, and people want to live there, and they're also happy to travel to the CBD as well. And with that infrastructure spending, a lot of the roads and the travel connections to the CBD improve over time. So it's not as long of a travel point to get into the CBD, and it's a lot smoother from that point of view. So I guess that objection of being further from the CBD isn't as big for some people.
Yeah, because I guess just thinking about an example, like, people wouldn't say, oh, Parramatta is X kilometres from the CBD, because Parramatta has kind of become its own CBD. So people aren't necessarily going into the city. But I guess the way that metric perhaps came about is there's the expectation is that's where the jobs are, or that's where the major employers are. And of course, post-COVID and mid-COVID, we saw that kind of get scrambled up, where people weren't moving into the office like they were before. The sort of influence of that seems to be unwound. It has changed the world. I think that's objectively true. But the majority of the people that are working in those, the big four accounting firms, the big four banks, they are probably going back to the office majority of the time. There might be a bit more flexibility, but do you think that's where that metric kind of still has some sort of pull over property prices and forecasting?
I think so a little bit. And like you said, it's not like everyone's working from home again 100% of the time. But I think for some people, if they only have to go into the office potentially 3 days a week and they're working from home 2 days a week, from a mindset perspective, it's like, oh, okay, well, it's only 2 or 3 days a week that I have to potentially travel into the CBD, and I can still work from home those couple of times. But again, it comes back to some people can afford those areas versus being closest to the CBD. So naturally, they're moving to those more affordable areas, and it's kind of that ripple effect. And I always say to clients, one of the easiest ways to kind of think about that ripple effect is we're Novocastrians in Newcastle, Merriweather, close to the beach, kind of increases in value first. And as people get priced out progressively, they move suburbs further and further out because they can afford to get into those areas. So that demand is there. It's just understanding the time in the cycle and where particular suburbs, local government areas are in their cycle.
Now, one thing I've learned interviewing a good couple of hundred people is they love to be put on the spot with a crystal ball and predictions that potentially they'll sort of live and die by the sword if they revisit it in 12 months. But
I'm sweating.
Good. That's what I was going for. Are we at the top of the market in Brisbane? I mean, that question of how long has it got to go? I mean, you've sort of said long term, I see the fundamentals. But for people that are obsessed about timing the market, obviously Brisbane's had a run. There's an argument to say that there are plenty of markets that are in the doldrums at the moment. Places like Hobart, which had its run, places like Canberra, which has been posting some ordinary numbers, and even Sydney to some degree. It's not red hot. Where is your mind kind of focusing for the next location around the country at the moment?
Well, we're not just solely focused on purchasing in Brisbane. And like I said, I still think that there is growth to be had in Brisbane if you're looking in the right areas. But we also are focusing at the moment on Adelaide, and we are also focusing on Perth, depending upon the individual client's goals, where their portfolio's at the moment, right? Because not every market suits the same client. And if they've got a couple of properties in different marketplaces, maybe they can mitigate their risk and go into that Perth market where it can be a little bit more volatile. It's a little bit more reliant on the mining industry and all the rest of it. So it's really just understanding an individual's goals. Where are you at? Where's your property portfolio at? And then finding a solution within that. But yeah, Brisbane, Adelaide, Perth, I still think are pumping along nicely.
Excellent. Well, to bookend the conversation, we started by setting the scene that it's the back of July 2024. What do you think investors really need to know and focus on for success in the rest of this year and beyond?
I think just don't get caught up in the mainstream media talking about interest rates and everything like that. Don't go over there and overcommit, overstretch yourself. Like I said at the start of this episode, there is a lot of ways where you can structure your purchase in a way where you're mitigating that risk. So just go out there, engage a professional or multiple professionals to help set yourself up for success when you're purchasing. But I strongly believe that property prices right now are on discount to what they'll be in 2-3 years' time. So it's more advantageous for you to go out there and take action now, because once we start to see those interest rates drop, there's going to be a lot more people come back to the marketplace because it's a little bit more affordable to hold properties, and it's just going to continue that pressure cooker at the moment, especially with the supply and demand issue we've got going on in the country.
Yeah, I couldn't agree more. I mean, we'll of course get you back in 2 to 3 years and replay this.
Hold me to it.
See if we can get you. But everything kind of points to the market continuing to hum along as it kind of always does. You know, not really caring about today's media stories. It's doing what it does. So, Casey, when it comes to I guess past performance is never an exact predictor of future performance, but you've got some data on a study that looks at a very broad time frame that gives you some confidence in Brisbane's ability to perform. What can you share with us there?
Yeah. So there was a really good article that Homely completed, and it was on 50 years worth of data in some of those metro locations. And it was from 1970 to 2016. And across that period of time, the average price growth in Brisbane was 9.7%. Sydney was 9.6%. Melbourne had 9.5%, and Perth 8.2%. So what
Yeah,
that really
interesting.
indicates and shows is over a long-term period, and as an investor, I always encourage people having that long-term mindset. If you can hold for 20 or 30 years and it's going to perform above average, you're going to do really well. So I think just that data point there showing that Brisbane over that period of time was actually the top performer, even only marginally, but it just shows long term it is a consistent performer. And if you can get into those marketplaces, it's going to do extremely well over a long period of time.
I love that. And what's interesting too is that those are average yearly growth over that long time period. They're higher numbers, right? Like even
Yep.
if you go down to what was it, Perth at 8.2, those are good returns, and that's the median. That's lumping the whole market. If you can select choice assets that outperform the average, which is very, very reasonable for property investors to do with a bit of research. All you've got to do is beat the middle. We're talking some pretty good returns over that time. Do you think that the world has fundamentally changed and the days of those returns are over, or is it still there up for grabs for property investors?
Yeah, I think that's a good question. And I think potentially I just like to build into the profile that we look at that it's probably not going to do 9.7% over the next 50 years, right? But even if it's a couple of percent lower than that and we're getting 5 or 6%, it's still really solid returns long term. And if we're getting close to that 9%, even better, happy days. Some of the clients that we're purchasing for at the moment in the last 12 months across different marketplaces, not just selective to Brisbane, but we've seen 20, 30%, even had a property that was revalued at 49% higher. Would never predict that it would val up that much higher, but it just shows that that long-term data is exciting. But if you're then going out purchasing in the right areas, you can get even higher returns, especially in that short to medium term, because then you can go out there, use that equity to get into another marketplace and diversify a little bit as well.
Love that. Casey, as always, it's a pleasure. Thanks for joining me.
Thanks for having me on, Mike. Appreciate it.